Carlton Brown, and I am a bank manager in the Baton Rouge and Hammond area. I have been given the task at looking at 3 portfolios to determine which company would I lend money to in the short term, which company would I lend money to in the long term, and also which company would I buy 50% equity into. The 3 portfolios that I am looking at are Kroger, which is the country's largest supermarket chain by revenue; Whole Foods, which is an American supermarket chain specializing in organic food; and also Hornbeck, which is a provider of marine services to exploration and production, oil field service, offshore construction, and also military customers. We are going to be looking at the liquidity ratios for the short term, the dew point analysis for the long term, and profitability for equity. All right, as a bank manager, if I wanted to lend $1 million in the short term to a company, what I would look at would be the current ratios, the quick ratio, and also the cash ratio. First, we're going to take a look at the current ratio. The current ratio is used to give an idea of if a company is able to pay off its liabilities. All right. A ratio under 1 indicates that a company liabilities are greater than its assets. And on the other hand, if the current ratio is above a 3, it may indicate that the assets are not being used efficiently. So if we were to look at the current ratios, we can see that Whole Food has a 1.3. Kroger, which is under 1, signifies that they have more liabilities than assets. And Hornbeck, which is at a 4.6, may signify that their assets are not being used efficiently. All right. So by looking at the current ratio, we can determine that Whole Food has the best current ratio. All right. Secondly, we are going to be looking at the quick ratio. The quick ratio determines if an asset can be converted into cash with only quick assets. Higher ratios are more favorable. A quick ratio of above 1 suggests that there is more quick assets than current liabilities. All right, so if we were to look at the quick ratios, we can see Kroger is at a 0.14, Whole Food is at a 0.7, and Hornbeck is at a 5.2. So we can determine that Hornbeck has the best quick ratio. All right. Lastly, we're going to be looking at the cash ratio. The cash ratio is used to see if a company is able to pay out its debts with cash and cash equivalents. A ratio of 1 means that a company has the same amount of cash as its debts. A ratio above 1 means a company has more cash than debt. All right, so if we were to look at the cash ratio, we can determine that Kroger has a 0.03, Whole Food has a 0.59, and Hornbeck has a 4.3, which means Hornbeck has the most cash ratio of the other 2 companies. All right. Best for short-term loan. If I were a bank manager and I were lending out $1 million, I would lend it out to Hornbeck. Hornbeck has more cash than debt. It is also able to turn quick assets into cash the fastest, and also able to pay short-term bills faster. All right. Secondly, we are going to be looking at the dew point analysis to determine who would I lend a long-term loan to. For this, we are going to be looking at a period of over 5 years. All right. The first ratio we are going to be looking at is the financial ratio, financial leverage ratio. The financial leverage ratio measures how much assets a company holds relative to its equity. High leverage means that a company is using debt to finance assets, and lower means that the company is less riskier. So if we were to look at it over time, from 2010 to 2014, we can see that Kroger has a high leverage ratio, It fluctuates from a 4.6 up to a 5.8 in 2013 and drops down to a 5.6 in 2014. Hornbeck, on the other hand, it's maintaining at a 2.2 in 2010, and it fluctuates and drops down to a 2.1 in 2014. All right, Whole Food goes from 1.9 in 2010, and it goes over to a 1.46 in 2014. By looking at this, we can determine that Whole Food is the most low risk company when it comes to leverage ratio. Secondly, we are going to be looking at the operation margin. The operation margin ratio measures the percentage of total revenue that is made by operating income. The higher the operation margin, the more it shows that a company is making enough money from its ongoing operations to pay for variable and fixed costs. All right, so if we were to take a look at this, we can see that Kroger fluctuates from 1.4 in 2010 up to a 2.7 in 2014. Whole Food is rising from a 4.86 in 2010 up to a 6.5 in 2014. Hornbeck, on the other hand, is maintaining a 2.6 in 2010, actually goes up to a 26.6 in 2010, goes up to a 31.2 in 2013, and slightly drops back down to a 2.6 in 2014. By looking at this, we can tell that Hornbeck is making enough money from its ongoing operations to pay for all its variable and fixed costs. Lastly, we're going to be looking at the asset turnover. The asset turnover ratio measures a company's ability to generate sales from assets. Higher ratios are more favorable. It can show that the company is using its assets efficiently. So we can see that Kroger is maintaining a 3.3 in 2010, goes up to a 4.0 in 2013, and slightly drops to a 3.6 in 2014. Whole Food goes from a 2.3 in 2010 and rises to a 2.5 in 2014. Hornbeck, on the other hand, is less than 1. It's a 0.22 in 2010 and pretty much stays even in 2014 at a 2.22. By looking at this, we can determine that Kroger has the highest asset turnover, which means that it's using its assets more efficiently. All right, now we have a graph of the leverage ratio where we can see that Whole Food has the best leverage ratio. All right. So as a bank manager, if I'm lending $1 million out for the long term, what I determine is Whole Foods would be the company that I would lend that money to. Whole Food has the best leverage ratio. Also, it has the second best operation margin and also the second best asset turnover. Lastly, we are going to be looking at profitability. If I were going to buy 50% of a company, this is what I would look at to determine which company would I buy that 50% in. First, we are going to be looking at the return on equity. The return on equity ratio measures a company's ability to generate profits from the shareholders. It also shows how effectively management is using equity to fund operations and also help the company to grow. Investors want to see a high ROE. It indicates investors' funds are being used efficiently. If we were to look at the return on equity, Kroger starts off at a 1.3 in 2010, and in 2013 it jumps up to a 36.27, In 2014, slightly drops to a 3.1, 31.4. Whole Food is pretty much maintaining steady at a 12, 12.01, and gradually increases to a 15.05 in 2014. Hornbeck, on the other hand, starts off at a 4.4 in 2010, goes up to a 9.05 in 2013, and slightly drops down to a 6.6 in 2014. By looking at this, we can determine that Kroger has the best return on equity. Second, we are going to be looking at the return on assets. The return on assets, it measures how efficiently a company can manage its assets to produce profits during a said given period. Higher return on assets is more favorable to investors because it shows that a company is more efficiently managing its assets. All right. So on the return on assets, we can see that Kroger goes from a 0.30 in 2010 and rises to a 5.6 in 2014. Hornbeck starts off at a 1.9 in 2010. In 2013, it goes up to a 4.0 and drops to a 3.07 in 2014. Whole Food, on the other hand, goes from a 6.32 in 2010, and it rises all the way up to a 10.26 in 2014. By looking at this, we can determine that Whole Food has the best return on assets. All right, lastly, we are going to be looking at the net income margin. The net income margin measures how much profits are produced at a certain level of sales. It also indirectly measures how well a company manages its expenses relative to its net sales. Companies strive to have a high net income margin. As we can see, Kroger has a low net income margin. Starts off at a 0.09 and rises to a 1.5 in 2014. Whole Food has a 2.7 in 2010 and rises to a 4.0 in 2014. Hornbeck in 2010 starts off at an 8.6 and rises to a 13.9 in 2014. So by looking at this, we can determine that Hornbeck has the highest net income margin. So, as a bank manager, if I were to buy 50% of a company, it would be Whole Foods. The reason being, it has the best return on assets, it has the second best return on equity, and net income margin. All right. So to summarize everything, as a bank manager, I would lend $1 million to Hornbeck for the short term. I would lend $1 million to Whole Food in the long term, and I would invest 50% into Whole Foods because they had the best liquidity. Thank you.